How do you get a loan after the bank says no? Well, you get a non-qualified mortgage or a non-QM loan. Okay, so first let's explain what a qualified mortgage is. Qualified mortgage, you probably heard it explained the other way: FHA, VA, USDA, conventional, conforming. You have to provide a verification of income, W-2, self-employment, tax returns. The debt ratio typically can't exceed 43%. The points and fees can't exceed 3% of the loan amount. It can't have any risky features like negative amortization, but it's not 08 anymore, so you don't have to worry about that. But it can't be an interest-only loan, and also the term can't exceed 30 years in length. So what's a non-QM loan? Any loan that fits outside of that box. If you're a self-employed borrower who doesn't show any income on their tax returns, a real estate investor with a lot of properties, a foreign national, prime, non-prime borrower, borrowers with significant assets that live off those assets but don't necessarily report income on that, and then also maybe medical professionals, special, physician loan or whatnot. So are these bad loans? Are they really risky loans? No. Many lenders have different requirements, especially different FICO requirements. Borrowers still need to show how they're going to repay for this loan. They just pay themselves differently than a typical W-2 employee. So 3 really popular programs right now that you might be hearing about would be a bank statement loan. Bank statement loan is when a business owner brings in 12 to 24 months worth of bank statements. The underwriter will review those statements and see all the income that's coming in, the expenses going out, and then they're able to piece together a monthly income that they're comfortable with giving to the borrower. The second program is an asset depletion loan. So that's when we take all your money, so savings, investment accounts, retirement accounts, and put them all in one big pot. And we say, this is how much money you have. And then we spread that out over 30 years. And that gives you a monthly payment. We don't physically take the money, we just need to see where it is and where it came from. And from there, the underwriter does their evaluation and say, borrower qualifies for X amount a month. The third popular non-QM loan that you might be hearing about is something called a DSCR loan. Now, I made a video about this before, but it stands for Debt Service Coverage Ratio, and it's used for investors to purchase properties. They don't show any income, but they're able to buy a property that can rent for, let's say, $1,200 or $1,000 a month, and they can rent it on the short-term market for $2,500 or more. Well, in that case, the income would service and coverage the debt on that property. It's important to know that if you've been turned down in the past, there may be other options for you now. New banks, lenders are popping up all the time. An example, some banks will deplete assets over 30 years, as I just explained. And I recently just found a bank that will deplete the assets over a 3-year period instead of a 30. That will boost the income. That has helped a couple borrowers get into homes that they didn't previously get into. I know what you're thinking, but wait, you said these loans aren't bad loans. They're not risky. Well, even the most aggressive lender or investor will have a set of guidelines that need to be followed. And that's why it's important to work with a professional in this field that has dealt with non-QM products before. For more information on how a non-QM loan could help you or your client get into their next home, please leave a comment or send me a text. And don't forget to share this video with someone who could benefit from a non-qualified mortgage loan.